Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First off, we'll have more on the latest inflation report as traders increase bets on rate cuts this year. Plus, the price is tight. We'll hone in on the state of the consumer as shoppers seek value as they navigate inflation. And we'll bring you the latest from Washington as President Trump looks to narrow the scope of his steel and aluminum tariffs. All that and more coming up on Market Catalyst. But first, let's take a look at what's going on the markets. After an eventful week, not a very eventful Friday in the markets in terms of at least the movement we're seeing right now. That's Bitcoin, but which is below 68,000. But let's take a look at the Dow. It's down by about 80 points, call it, or so right now. The S&P 500 only down a tenth of 1%. The Nasdaq down about a third of 1%. But I do want to take a look at the week here because what we're seeing today doesn't really encapsulate the sort of wild week that we had, especially the selling pressure that re-intensified yesterday. And so that means the Dow is lower by 1.5% on the week. So is the S&P 500, and the Nasdaq is off by more than 2%. So we continue to have this market that is very sensitive to AI threats to existing businesses. Really, it feels like we've got the market trying to grapple with some of these big questions. This morning, of course, we also got some economic data. We got the Consumer Price Index, CPI, coming in a little bit more mild than expected on the headline number. We've had yields moving broadly lower throughout the week. Not much changed here this morning. We looked at Bitcoin before, but I think it's worth mentioning that as we saw the selling in stocks yesterday, we also saw some selling pressure on Bitcoin once again. And I, of course, was at the Bitcoin Investor Week conference yesterday talking to a lot of folks who are long-term Bitcoin bulls, but who did not necessarily see any short-term catalyst for recovery in Bitcoin, which was telling. And while Bitcoin is under pressure today, gold is coming back a little bit from its lows, even though it still had a rocky week as well. Of course, we have seen some of the biggest drops within the tech complex, and we've got a mixed picture within tech today, so not necessarily seeing a broad recovery. The 5-day look here, it's a pretty ugly one, right? You've got Alphabet down 5% in the week, Apple down 6.7% this week, Amazon down nearly 6%. Microsoft is a little bit of a bright spot, Tesla's a little bit of a bright spot, but in tech we have seen a lot of selling, and we've seen, as we've been talking about throughout the day, that selling really extend into other areas of the market as well, not just within tech, but anything that could be maybe threatened by AI. Financials, the worst performing group this week. And by the way, if you look at the year to date as well, guess what? Those financials are in that lagging position. What is going on there? Maybe there's more concern there that we could see an AI threat. It's an interesting conundrum because we do have a lot of individual strategists that we've spoken to who said they like financials right now. Energy, the best performers on the year. On the week here, utilities, materials, and real estate have been gaining some steam. All right, let's get back to that inflation data and what consumers are seeing right now. The latest data showing inflation rising less than expected in January. We've talked to a number of executives about how the consumer is shaping up in 2026. The biggest theme we've been hearing is in one word: value.
The middle, lower income consumer, quite stable, same as last quarter, but still very stretched in their budgets, trying to be choiceful and cautious on how they spend their money, especially discretionary categories.
And the reality is different guests have different needs. So that guest that only wants that hot price point, there are things for them. So no matter where you shop the menu, you're going to get great values.
And they're still spending in this tough economy. So we're going to lean into those consumers with brand innovation, menu innovation, and really give them more compelling reasons to come in.
And we talk about the fact that we've made, I think, significant progress on our value and affordability platforms and how those are resonating with consumers.
A new report on the state of consumer spending in 2026 reiterates the point that consumers are firmly focused on value. 62% of shoppers now prioritizing price over brand when making purchase decisions. Joining me now is Bryan Leach, founder and CEO of Ibotta, which is a site that helps with people shopping, helps them get cash back, etc. Bryan, I'm curious how this is playing out, what you guys found in this survey, because it seems like people, even though, you can look at the economic data all you want and see that inflation is moderating, but prices are still going up. They're just not going up as fast. And so is that really what we're seeing affect consumer behavior here?
That's right, Julie. I mean, first of all, it's true that the CPI was a little bit, more muted. However, food prices have been going up at much faster paces. So you saw a 2.9% increase in food prices in January. That vastly outpaced overall price increases, and that's actually accelerated in 5 of the 6 leading metrics on food prices. So consumers, in terms of everyday items, are very much still looking for value, and that's what you can see in our State of the Spend report.
Okay, so we showed that 62% thing that people are prioritizing price over brand. And, it also, I guess, shows that the share of spend and where people are spending the money. If food prices are going up, that means people are spending more money on food, right? 18% is their share here, where people are planning to spend. I don't know if you can sort of suss out how much of that is because prices are higher. I don't know if it's because people are buying more food. So I assume it's because prices are higher, right?
That's right. I mean, these are largely non-discretionary categories that we primarily focus on, kind of fast-moving consumer goods that you buy in places like Dollar General and Walmart. And those are places that are perceived to have a higher level of value. And there's been a flight toward those retailers that have that level of price competitiveness. You're also seeing other attitudinal changes that are noteworthy in the shopper. So you mentioned the 62% are keyed off of price rather than brand. You also see that 68% of new products are being discovered via a promotion. You have about 26% of the basket that's up for grabs, but price is the primary determinant of switching behavior. For a long time, these prices have been going up. Consumers have been fleeing into private label. And now these brand companies, you just interviewed the CEO of PepsiCo, for example, are trying to recapture market share through intelligent use of promotions.
Okay, so tell me what those promotions look like. How they're reacting, how the consumer brands are reacting, and then how individual shoppers are reacting.
Yeah, so one thing that's interesting from our survey, so we survey 5,000 shoppers every year in this detailed survey we call the State of Spend report. And one of the things that jumped out to me was that you had a 7% decrease in list making in terms of determining what you're going to buy before you walk in the store. And actually now 32% of surveyed shoppers say they make spontaneous decisions about what to put in the basket based on price and whatever else they encounter in the aisle. Right. And so brands recognizing that realize that they need to communicate their value proposition in a number of different ways. Of course, their packaging, their placement on the shelf, but increasingly it is being able to use price intelligently. And so, for example, they work with a company like Ibotta to figure out what's the right offer for the right consumer at the right time to change their behavior and make sure that they buy something in the brand that they would have otherwise not bought. They either bought it more often, they bought more of it, or they bought their brand instead of a competitor or instead of private label. But you don't want to do that in a kind of a one-size-fits-all way where you just unnecessarily erode the margins in your product. You want to figure out how to stretch consumers using those dollars as intelligently as possible.
One of the other findings from your survey that one of our producers thought was bonkers was people going to the store without a list and instead letting their behavior be governed by those promotions that they're seeing. I'm a sometimes list maker, admittedly. I don't know how you shop, but it kind of depends on if I'm making a particular recipe. Otherwise, I kind of buy the same stuff week over week. But I do pay attention to what costs what, and that also drives my behavior. So is that what the list change is all about?
Yeah, I think you're right. Your experience, Julie, is broadly representative. 56% of shoppers surveyed in our study said that they expected to receive some kind of digital coupon or value in order to influence their decision. And about 26% of the basket that someone buys is different, is open for grabs. So they have their things that they know they like. That's kind of 3/4 of their basket. And that you might put on a list. Right, but the other 26% is up for grabs, and the primary driver of how you capture that is value delivery and affordability.
The other thing I'm curious about, we've been talking about consumers as one thing, right? Where obviously the other thing that characterizes consumer spend right now is that it looks very different for upper income Americans and lower income Americans. And I wonder if you saw those kinds of differences in your survey, or if you're mostly trying to capture the sort of, bottom 50% or even bottom 75% of folks?
What's interesting is that we survey a whole swath of different shoppers. People who shop in store, people who buy ahead, pick up in store, people who shop online. And it's no longer the case that, you can assume that someone who shops online is affluent and price insensitive. In fact, they're very price sensitive. And so you see that as we deliver our program, the Ibotta network delivers digital promotions through Walmart, for example, through Dollar General, through Family Dollar. And many of those are people buying those things, online in addition to in store, but they're value seeking shoppers. And so across the board, everybody, I think when you're talking about things that you're providing for your family every week, every other week, is looking and views it as part of their job as sort of the person stewarding those resources for the family to get the best possible value. And so they're going to shop in places where they perceive they get that, and they're going to buy brands that get it and realize that multiple years of compounding price increases have lost them the loyalty of their consumers, and they need to intelligently regain that.
Interesting. Bryan, thank you so much. Really interesting stuff. Appreciate it.
Thanks, Julie.
Coming up, with electricity prices and demand on the rise, some of the risks to the U.S. power grid and how perhaps it can be made more resilient. That's next. Power demand is on the rise as companies pledge billions towards energy-intensive data centers, but our infrastructure is aging. A new report from the North American Electric Reliability Corporation, NERC, finding that tens of millions of people live in areas with a high or elevated risk of electricity shortfalls. One company working to fix that is American Superconductor, and Daniel McGahn is the president, chairman, and CEO. He is with me now. It's good to see you again, Dan. Thanks for coming in.
Thanks for having me. I appreciate it.
So you guys make transformers, which are obviously vital to the electric grid. And it feels like we are paying more attention to this than we have in a long time, in part because of data centers, in part because of reliability, in part because of prices. Where are the biggest pain points within the grid right now?
Well, a lot of it we have simple electrification happening, right? Everything that you use now uses power, right? So you're becoming more and more dependent upon it. And the pain points really come from, do you have access to reliable power for manufacturing or for consumers? And as you're more dependent upon it, it has to become more reliable. There's a real challenge, I think, in the market where people that are used to computers assume an uptime of a certain level. And the electricity grid isn't designed really to do that. So there's going to be tremendous investment into the grid to really bring up the level of service, meaning being able to provide resilient power all the time. And that's just an investment that's going to happen because we're asking the grid to do more than it's designed to do.
So to just back up a second, when we talk about the increasing electrification, people focus on things like electric cars. And electric cars are part of it, but like heat pumps, right? Mm-hmm. Which are sourced from electricity. What are some other real changes you've seen?
You just think about everything you touch throughout your day. Pretty much half of the things you physically touch consume power,
by
right?
Electricity
and
first,
everything more and more is trying to get smarter and talk to more things, and they all require electricity. The overhead lights, although we've tried to bring demand down, it's a big demand for power. And most people don't really understand what drives their power bill. I've seen, in talking to utilities, they've had a lot of outreach to help lower consumer demand, and that's worked to some extent. We're now asking, manufacturers are asking for more reliable power. Computational capability, data centers, things like that, really need high levels of power quality and persistent level of power. And that's a challenge. And it's a challenge, I think, that will be met, but it's going to take time and investment.
And there's a lot of different questions involved here. So leaving aside the question of power generation and where it comes from, how do you make the electricity? There's that question of reliability, which you brought up, which is also has implications for what we all pay for power, what companies pay for power. Because if you have to update the grid, it's going to cost a lot of money. And it doesn't seem like there's any way around that. It has to be done. Is it being done right now, though? Are those reliability investments being done?
I'd say that they are, but they're probably not being done at the rate that we think the future is going to need, right? So I think that there's a little bit of playing catch up that's going to happen. But in at least my discussions with utilities, they understand the problems ahead of them. They're very well suited and very well positioned to do that, but it's going to take time and investment to be able to get there.
And who's going to pay for it?
Ultimately, it's going to come down to the consumer. It could be the individual consumer, but it probably will mostly be burden of industry or businesses that are very electricity sensitive.
And I know to take it out a little bit to the power generation side of it too. I mean, that's also part of the problem is that there's only so many natural gas plants that can, et cetera, et cetera. So I assume we're also going to need an increase on the generation side.
Yeah, and we're seeing some benefits from that as well. One of the things that we've done as kind of an expansion of what we do even since we first met is to become more a participator in traditional energy. So how do you make and move those modalities of power? There's a tremendous investment going on there that's going to have to continue. I mean, our lives are becoming more electric. And the world has to be able to meet those demands.
All right, let's bring it to your business. All of this is good for your business, right?
It's all great for our business.
Because the utility business, that transform business, is still the biggest part of your business.
I wouldn't say specifically transformers. Gotcha. It's part of what we offer. A lot of what we do is we power and we provide power quality, power conditioning. So for problems to mitigate, a lot for industrial consumers. So as they're going to build plant equipment, which is going to generate more capability capacity, they need more power and they need more reliable power. And that's where AMSC comes in and kind of fills that gap. How do we get the grid to do more locally for that local capacity investment? And
what does that demand look like and where's it coming from?
Yeah, it's coming from a variety of markets. So for us, I mentioned traditional energy, a lot of materials, so mining, processing materials, a lot of things in traditional energy like oil and gas. We do have businesses as well directly to utilities. We have a small part of our business that's still with military, but a lot of it's really going to be driven by the manufacture processing of materials and fundamentally energy. How do we move the oil and gas to where it needs to go?
And we've talked about it a little bit before, but in terms of sourcing, making your stuff, supply chain, tariffs, how is that all working at the moment?
It's worked out pretty well for us, I think, because we're in a little bit of a unique situation. For our American-made products, our supply chain is almost all in America. So we don't really have to worry so much. There'll be a part here or a part there, and people on the team get very focused on that to make sure we have reliability of supply. But from a cost standpoint, it really hasn't hurt us financially in the aggregate. We're also now starting to look at other markets in Latin America.
Right, you guys just made a big acquisition in Brazil, right? Are they facing the same challenges that we're facing here in terms of the grid, in terms of data centers, et cetera?
They're facing all those challenges and they're investing maybe differently. So there's a very large central government investment in the grid. And we see that as a great opportunity. That's a company that we think can grow pretty substantially in the coming years. And eventually we see the ability to bring everything we have to bear across the entire Americas.
That reminds me of something else I wanted to ask you, which is whether you think that policy here is supportive enough of grid resiliency. Do you think there is enough sort of policy attention being paid to this issue?
I think it's becoming more front and center. We've worked with some utilities and some state governments to look at resiliency as another economic factor. So not just being able to provide at a certain cost, but to have that stability and resiliency and looking at scoring of a project. It's a difficult market for utilities, to defend my customers. They have a regulated environment. They're not trying to raise rates on people, but as the demand happens and the grid is asked to do more, like you said, that investment has to come somewhere. And I think utilities are able to meet that demand, but it is going to take time and investment.
Yeah. All right, Dan, good to see you.
Thank you.
Thanks for coming in. Appreciate it. We got much more markets action coming up, including a check on what's going on in Washington. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Rivian, Pinterest, and Moderna. First up is Rivian. Shares are soaring after the EV maker reported better than expected fourth quarter results. Rivian also recorded its first ever annual gross profit after years of consistent losses. The company said it expects deliveries of its long-awaited R2 midsize SUV in the second quarter. Investors are hoping the more affordable midsize vehicle could bring in a wider array of customers. If today's gains hold, the stock would nearly erase its year-to-date loss of 29%. Next is Pinterest, the stock plunging to its lowest level since 2020. The social media company gave a weaker than expected first quarter forecast. That is prompting 6 analysts on Wall Street to downgrade the stock. The weak results come just weeks after it announced layoffs and a pivot toward artificial intelligence products. And Moderna, the vaccine maker, out with earnings results. The company reported revenue for the fourth quarter that beat Wall Street's expectations. Aside from the results, investors are focused on recent setbacks the company faced with the FDA. Remember, regulators refused to review its mRNA flu vaccine. That was a major setback. On the analyst call this morning, CEO Stéphane Bancel said the agency has become unpredictable. If the FDA keeps it up, Bancel says it, quote, threatens U.S. leadership in innovative medicines. The flu vaccine is key to the company's forecast that it'll break even by 2028. Moderna is grappling with slowing demand for its COVID vaccine. Let's turn now to Washington. President Trump may be rolling back some of his planned tariffs. According to the Financial Times, the president may be narrowing the scope of his steel and aluminum tariffs. And our Washington correspondent, Ben Worshkel, is with me now to discuss. This follows the rollback of various sort of specific tariffs that we have been seeing gradually. So what do we know about this potential one and the effect it could have?
Yeah, you're right that this would be kind of the latest in a string of tariff concessions from Trump, scaling back some of his tariffs in response to these affordability concerns that have emerged as a giant political issue. In terms of this one specifically, the debate here appears to be amid the administration about scaling back tariffs on specific goods that have steel and aluminum in them, basically excluding those goods, which would then lower the prices of those goods. This overall would be a really significant pivot for Trump if this goes forward. The signals from the White House are that it's still a debate going on, but it's clearly under consideration here because how important steel and aluminum tariffs have been to the president. Going back all the way to his first term, remember, even in his second term, these new tariffs were some of the first ones out of the gate. And you see Trump officials often traveling to things like U.S. steel plants to tout these tariffs as protecting this industry there. So far, the White House response today has been to kind of downplay these, but acknowledge that there is a debate here. Treasury Secretary Scott Bessent was on CNBC. And he described it as a potential clarification on incidental objects. Still don't have a lot of details on what exactly objects would be there, but the reporting we have is broader than that. These are a lot of goods that could affect a lot of people. In the reporting this morning, washing machines, ovens, pie tins, and drink cans were all mentioned as possible exclusions here. That lowering prices there would quite literally hit home for folks in these lower prices as these affordability worries continue this midterm year.
Meanwhile, we're on shutdown watch, right? Right now, it looks like that Polymarket is pricing in a 25% chance that there could potentially be a shutdown after Democrats voted to block a motion to advance a House-passed bill to fund the Department of Homeland Security. So, Ben, what is this? What's the partial shutdown, and what is the whole situation here?
Yeah, we seem very likely to be headed into a shutdown. It's only a few hours away. This partial shutdown would happen at midnight tonight. Many lawmakers have actually already left Washington. This is the beginning of a recess. Some are traveling overseas, so it seems very high likelihood that this partial shutdown is in the offing, even as negotiations are forward. This is a kind of unique one because it's a very, very partial shutdown. There's 12 areas of government funding. 11 of them are done. Those aren't going to be impacted this weekend no matter what. It's this 12th one, the Department of Homeland Security, which by one measure is 4% of government funding, that is at issue and could be shut down over the weekend. This is an important department, the Department of Homeland Security. It touches a lot of areas, including some of interest to the economy and to markets. The TSA is part of a department. FEMA is part of the department. The Coast Guard is part of the department. And so those could feel a pinch in the next few days, depending on whether this shutdown begins and how long it goes out. Perhaps ironically, this whole shutdown is about immigration and about the administration's role and conduct in immigration over the last few months. Those areas of the department actually aren't expected to be overly affected by a shutdown. ICE, the Border Patrol, they have separate funding that Republicans passed in the last year. So they could kind of continue as they are, but this is clearly a back and forth as Democrats try to use this as leverage to get some changes in how the Trump administration approaches immigration. As for negotiations, they're apparently still going back and forth. The White House and Chuck Schumer, the Senate Minority Leader, are the main people negotiating there. But logistically, at least to this point, it's very likely we're going to have at least a shutdown begin this weekend, depending on, and then the question becomes potentially how long does it go?
Oh, I love having this conversation again.
Third in the last 6 months.
Yeah.
That possible shutdown.
Ben, thank you. Appreciate it.
Bye.
By the way, if you want to look at more prediction markets, you can check out Yahoo Finance Prediction Markets Hub. It's powered by Polymarket. Sticking with Washington, the Trump administration is making a major regulatory move when it comes to the climate. The White House is repealing the Obama-era finding that has served as the legal backbone for federal greenhouse gas regulation. The target, the 2009 quote-unquote endangerment finding, that concluded that 6 greenhouse gases pose a threat to public health and welfare. President Trump said the decision is, quote, the single largest deregulatory action in American history. That finding has been the legal foundation for major Environmental Protection Agency climate rules, including limits on emissions from power plants and tighter fuel economy standards for vehicles, all under the Clean Air Act. The rollback is expected to remove federal requirements for industries and automakers to measure, report, certify, and comply with greenhouse gas emission standards. It would also repeal related compliance programs, credit provisions, and reporting obligations. For now, it looks like it will affect the auto industry, but not yet those power plants. So watch this space. A quick programming note, tune in at 3 p.m. Eastern for an interview with Austin Goolsbee, president of the Federal Reserve Bank of Chicago. And coming up, SpaceX merging with XAI ahead of its highly anticipated IPO, what that means for investors, next on Market Catalyst. SpaceX is gearing up for one of the most anticipated IPOs in market history, with Elon Musk signaling a potential July debut. Yahoo Finance's Josh Lipton spoke to Lisa Rich, Explorer Chief Operating Officer, about what it means for investors.
Lisa, it is good to see you. I hear, Lisa, you're coming to us from a Tesla via Starlink. So you are all in on the Musk empire. Let's dig into this empire because, Lisa, as you know, SpaceX, lots of talk, lots of headlines about an IPO. Lisa, you're a SpaceX investor. Your thoughts on this? I would imagine, Lisa, you wouldn't mind seeing a public debut here.
Thank you, Josh. Not at all. And had I had the opportunity to ask Elon during Davos what his plans were, of course I would have. At USA House, they had an amazing presence there. But we've got amazing opportunity here with all the progress that SpaceX has made. Starlink, obviously, I wouldn't be talking to you right now without it. The concept of Starlink connect with all the Teslas and having that integrated would be amazing. So all these properties that Elon has, could you imagine if they're all folded up into one, more like the Alphabet story, which merged Waymo and YouTube, which were valuable properties in and of themselves. So when we had the private story that came out, private company of XAI merging with SpaceX, that was huge news. But what happens next, I think, is the big question. Because if you look at all these other properties that Elon has launched, all of which are making revenue in and of themselves, that's one thing. But his ambitions are huge. They're capital intensive. The idea of going to the moon and commercializing that, we're talking about even bigger money that's required, which is why going to the capital markets makes sense at this time and rewarding all of the success that SpaceX has had up until this point.
Can I ask you, as an investor, how would you go about thinking how to value SpaceX, especially after this merger with XAI? Like, what's the comp, Lisa? Is there a comp? Is it tech? Is it aerospace? Is it one of one? How would you think about that?
Well, I think it's adding, 1 + 1 = 5, in this case. But can the market achieve a valuation that's acceptable if they combine forces? Because they're all valuable in and of themselves. And if you think about the value in the trillions, and of course, factoring in the future plans, that's a big question. So is there a comp? No. I don't think there is one. This is really a story of our lifetime right now, is where we're headed next with the financial story and, of course, the physical and digital story of what they can accomplish.
As an investor in SpaceX, Lisa, I'm curious, when you saw, okay, they're merging with XAI, did you look at that, Lisa, and say, yes, that makes sense. That makes sense financially, that makes sense strategically. It creates a stronger story overall, or did you think it complicates the narrative? Walk me through it.
No, I think XAI and their plan, which is the digital side of connectivity for a whole universe that they're trying to build for us. When Elon talked about it in his all hands, he said he wanted people to live their life on the app, XAI, and they just introduced the money side of this. It all flows together, and it did make sense to me. But now, what does it mean for an IPO and the value? And timing, not sure, because the original thought was middle of the summer, I think.
Let me ask you, Lisa, I want to get your take on these headlines we saw this week. Reports of departures of XAI, co-founders, that's coming after, it looks like, several other founding members too. As an investor, did you look at that, Lisa? Was that, is that any kind of red flag to you, or no, that's just, hey, that's normal scaling going on?
It wasn't to me, because I am a founder and I've never scaled something like what Elon has done. However, you go through these stages, and the people that you hire at the beginning of the company are not the people that are the skill sets that you necessarily need for scale and growth. So a lot of those folks sit well in that early stage environment, but then when you need to get management in place and larger teams in place, it gets more complicated. So you need people with those skill sets. So it's an evolution that does have to happen, and he kind of bit the bullet and did it.
Last question, Lisa. I'm curious, as a SpaceX investor, and you outlined all these grand opportunities and ambitions, and that's why you saddle up with Elon Musk, because he swings for the fences, right? I'm curious though, before you put money to work, what were some of the risks you thought about with SpaceX? Was it national security concerns? Was it regulatory issues, competition? How did you frame it?
Well, I would say the government was one of the biggest challenges for SpaceX, because they were going to provide a service, but they had to prove they could do it. They had to prove they could do it at a lower cost and then reliably. So they've done that with cargo and then crew missions. And now the idea of, instead of going to Mars first, going to the moon first, this cadence of launch that they've achieved for getting mass into orbit is so phenomenal. Can they do that for the moon? And that helps us actually have a reliable launch cadence that lowers the price, that helps us have a real commercialization story. So there is a commercialization story that's happened with launch today, because he's been able to get so many companies to launch. And then as you're thinking about orbital data centers in the future, which is huge mass that has to go to launch, that's huge cost. And we need Starship going and regularly. So that's kind of the next phase. So he's proven what he's done. He's faced, lawsuits and whatever. He's had all the challenges with constraints with government side of things, and proven himself. So what if he could prove this again and really enable Artemis and the work that they need to do on the moon, and get it to be that commercial story that we've all been hoping for?
Lisa, coming to us from a Tesla via Starlink. What better way to talk about all things Musk? Thank you, Lisa, as always.
You're welcome. Thank you, Josh.
Today's inflation outlook, not only having investors think in the short term, it also puts a spotlight on financial planning in the long run as people plan on their retirement. The risk of inflation can be a killer, and it can silently drain your assets. So how to avoid this problem? Kevin Thompson's here to help, founder and CEO of 9i Capital Group, for this week's FA Corner, brought to you by Capital Group. Good to see you, Kevin. I'm glad you could join us. And I think this is a really important question that people don't think enough about, right? I think everybody, you go to the grocery store and things are more expensive than they used to be. But the calculation changes when you're in retirement, when you're on a fixed income and drawing from your investment. So how do people have to account for this?
You're absolutely right. And thank you guys for having me. So inflation is one of the silent killers when we talk about from a retirement perspective. I mean, think about it from a retiree's perspective. If you're a retiree in Florida, guess what just happened to your homeowner's insurance? It quadrupled. So a person in Florida, their inflation is different than a person in Texas. And it's my job as a financial advisor to make sure that we're not just using some fictitious number of 2.34% because that's what they tell us inflation has been over the last 30 years. What's funny to me is that as a financial advisors, we talk out of two sides of our mouths sometimes when we talk about past performance is not indicative of future results. But when we talk about inflation, we use a 2.34% number because that's what the last 30 years told us. And then we tell people to stay invested in the markets because markets are always up and to the right. It's important for us to understand that inflation is different for everybody, and past performance in this circumstance is not indicative of future results.
So so if that's the case, what inflation should people be prepared for, and where in their budget do they need to really focus on that inflation being hot?
So I'm more aggressive. I use 3%. People say 2.34, 2.4. I'm more aggressive. If I'm more aggressive, I'm okay with that. They may spend a little bit less than they're supposed to spend, but I'm okay with being wrong on the higher end. The worst thing you can do is be wrong on the lower end and someone runs out of money. So the best way to combat inflation for us is to invest in equities, right? And equities outpace inflation over the long term. So we want to invest in equities. The best way to do that is to hold 12 months, 12 to 18 months of cash on the sidelines. Now, I hear advisors out there screaming at me right now, Julie. They're screaming at me. How is that inflation hedging? Well, if I hold cash on the sidelines, guess what? I can be more aggressive in my portfolio, and I don't have to worry about the vicissitudes or the volatility of the stock market because I can go into that cash, pull out cash, and if the market's down enough, hey, I can be more active in buying things on a discount.
And Kevin, I know that so inflation is one side of it, taxes are another side of it, and tax planning. How does tax planning, how is it informed by that inflation planning?
Tax planning, in my humble opinion, I know they say tax planning, tax advising. We are enrolled agents here, so we can talk about tax advising. Tax planning, tax advising is where we typically start. IRMA taxes, Medicare taxes, all these different things that are popping up for individuals in retirement, especially the one thing no one ever talks about, that widow's penalty. Yes, that widow's penalty. You'll have Social Security coming in, your pension coming in. One of the maybe the breadwinner somehow passes away. Now you have their RMDs kicking in as well. You start getting into those compressed marginal tax rates. Taxes absolutely explode for people later in retirement, especially when they lose a loved one. And those are the types of things that need to be addressed, possibly doing some Roth conversions earlier, and especially with the enhanced deduction that we currently have with the O3BA, was it the O3B? I mean, you can do very good Roth conversions using the enhanced deduction to offset some of that cost. I think that's something that's often overlooked.
I like that O3B or OB3 for the one big
we call it O3B.
Yeah. I like that. I like that nickname for it. I don't know that I've heard that as of yet. So as people come to you and they're trying to plan for those retirement years, what's the biggest question that you get? Does it have to do with these issues, or is that something that you really have to educate folks on?
The most important thing I educate people on, like I just had this recent conversation, is that what happens when you're no longer there? Those marginal tax rates and the compressed tax rates and then the IRMA taxes that people are going to feel, they don't necessarily see that. So that's an education piece. And on top of that, the most important thing is taxation inside of retirement. We start with the tax plan. So taxation inside of retirement is where we always start getting someone's 1040, kind of seeing exactly what that X-ray looks like, so we can make the best moves moving forward from a tax perspective, especially when we're talking about Roth conversions, how much money we should distribute from the accounts. And basically just maximizing those marginal tax rates as much as we possibly can, because we're always going to say like, oh, the qualified account, you're supposed to put it in at a high tax bracket, take it out of the low tax bracket. Well, majority of my clients are in either the same tax bracket or higher in retirement, so we want to make sure that we're combating that as much as possible.
Kevin, good to see you. Thanks a lot for joining us.
Thank you for having me.
Appreciate it. That was FA Corner, brought to you by Capital Group. And that does it for me and for Market Catalyst for the week. Thanks for watching. We've got more Yahoo Finance coming your way next.